The housing crisis is not a bubble waiting to pop. It is a permanent structural shift, and the moment you understand the difference, you will never look at property prices the same way again. The crash your parents are predicting is not coming, and the reason why is hiding inside the global financial system. The average first-time buyer is now 35 years old, a decade older than their parents were. That lost decade is not an accident, and it is not a temporary inconvenience. It is the measurable consequence of a structural transformation in how housing is classified, priced, and traded, one that most people living inside it have never been told about. Before we get into the mechanics, drop your country in the comments right now. US, UK, Germany, Australia, Canada, wherever you are watching from. Because this story looks different depending on where you live, and I want to see exactly how global this community actually is. This channel exists for one reason: to make the systems that shape your financial life genuinely understandable, not oversimplified, not sensationalized, just clear. If that is what you have been looking for, subscribe now, because this is what we do here every single video. Now, let's break down exactly how this happened and why it is not going back. Your parents bought their first home in their mid-20s. It was not a mansion. It was not in a premium neighborhood. It was a modest starter home, a place to begin, and it was within reach. In 1985, the average home in the United States cost approximately 3.5 times the median annual income. In the United Kingdom, the ratio was similar. Across most of Western Europe, buying a first home before 30 was not a financial miracle. It was simply what you did next. Today, that ratio has more than doubled. According to OECD housing data, the average home in most major US, UK, and Eurozone cities now costs between 6 and 9 times the median annual income. In London, it exceeds 12 times. In Sydney, it approaches 13. You have felt this. You have done the calculations. You have looked at the mortgage numbers and then looked at your salary and wondered when exactly the math stopped making sense. And so you waited. You told yourself the same thing that millions of people across the US, UK, and Europe have been telling themselves for the better part of a decade. This is a bubble. It has to burst. Just wait. The logic is sound. It is historically defensible. Every major asset bubble in modern economic history has eventually corrected. The dot-com crash of 2001, the global financial crisis of 2008, markets overheat, markets cool. That is the cycle. But here is the question nobody is asking clearly enough. What if this is not a bubble? What if the housing market did not overheat temporarily? What if it structurally transformed? What if the version of the market your parents bought into, the one where a single income could reach a starter home, no longer exists as a functioning system? According to the OECD, home price-to-income ratios have not just risen. They have risen consistently across nearly every major economy for over 2 decades without a meaningful correction. That is not bubble behavior. Bubbles burst, structures do not. The difference between a bubble and a structural shift changes everything. A bubble tells you to wait. A structural shift tells you to understand what changed and why. And what changed is not what most people think. The answer is not greedy landlords. It is not simply a shortage of supply. It is something more fundamental, something that happened quietly in the years after 2008 and rewired how the global economy thinks about the place you call home. To understand why the bubble never popped, we have to look at who started buying the houses, and more importantly, why they will never stop. Because the buyers changed, not gradually, fundamentally. And once you see who is now sitting across the table from you at every property auction, every new development, and every foreclosure sale, the market starts to make a different kind of sense. For most of modern history, a house had one primary purpose. You lived in it. Its value was local. It was determined by the neighborhood, the school district, the commute to work. It was bought by families for families, using locally earned wages and locally issued mortgages. That is no longer the primary logic of the housing market. Something changed, and to understand what changed, you need to understand one word: financialization. Financialization is the process by which an object's value stops being determined by its usefulness and starts being determined entirely by its potential to generate profit. The house stops being a home. It becomes an instrument, a vehicle for returns, an entry on a balance sheet. This shift did not happen gradually over decades. It happened at a specific moment in time. 2008. When the global financial crisis collapsed the housing market, something unexpected occurred. Prices fell sharply across the United States, the United Kingdom, and most of the Eurozone. For ordinary buyers, this was devastating. But for large institutional investors sitting on significant capital, it looked like an opportunity that had never existed before. For the first time in history, it was operationally possible to buy thousands of single-family homes at once, at scale, across entire cities. And they did. So who exactly are these new players? The primary vehicles are REITs and private equity funds. A REIT, a real estate investment trust, is a company that owns income-producing real estate and sells shares of that portfolio to investors, in the same way you would buy shares in any publicly listed company. In the UK and EU, equivalent structures operate under different regulatory names but follow identical logic. Buy property, collect rent, distribute returns to shareholders. Since 2010, the total market capitalization of residential REITs has grown by over 400%. That is not organic growth driven by population demand. That is institutional capital recognizing that rental housing is one of the most reliable income streams in the global economy. According to CoreLogic data, by 2023, nearly 1 in 4 single-family homes sold across the United States was purchased by an investor rather than an owner-occupier. In certain markets, Atlanta, Phoenix, Miami, that figure exceeded 1 in 3. In the UK, buy-to-let portfolios expanded dramatically through the 2010s before partial tax reform slowed individual landlords. But institutional capital simply filled the gap they left. In Germany, large residential property corporations like Vonovia came to own hundreds of thousands of apartments across major cities. The faces changed, the dynamic did not. But why do institutional investors want houses so badly? The answer comes down to one concept: the store of value. A store of value is an asset that holds or increases its purchasing power over time, particularly during periods of inflation. Gold is the classic example, but housing, it turns out, has properties that make it even more attractive to large-scale capital. It generates income through rent. It appreciates in value over time. It is a physical, tangible asset that cannot be replicated digitally. And in an era where central banks across the US, UK, and Europe kept interest rates near zero for over a decade, the returns on traditional safe investments like government bonds became almost non-existent. Capital needed somewhere to go, and it went into your neighborhood. The result is a structural dynamic that is entirely different from the bubble logic we talked about earlier. Bubbles are driven by speculation and irrational exuberance. They burst when sentiment changes. This is not sentiment. This is institutional strategy, built into quarterly earnings reports, built into pension fund mandates, built into the operating logic of the global financial system. The buyers changed permanently, and that changes the price floor permanently. But this shift did not happen by accident or by simple opportunism alone. It was made possible by a specific financial mechanism that turned your rent check into a tradable security on the global market. That mechanism is called securitization. And once you understand how it works, you will understand why global pension funds in Tokyo, sovereign wealth funds in Abu Dhabi, and insurance companies in Frankfurt all have a financial interest in the price of a two-bedroom house in Birmingham, Baltimore, or Bordeaux. To understand why institutional capital flooded into housing, you need to understand one word that drives every major financial decision on the planet. Yield. Yield is the return an investor earns on their money. It is the profit generated by putting capital to work. And for most of the period between 2009 and 2022, yield had become nearly impossible to find in the places where large institutions traditionally looked for it. Here is why. After the 2008 financial crisis, central banks across the United States, the United Kingdom, and the Eurozone made a historic decision. They cut interest rates to near zero and kept them there for over a decade. For ordinary people, low rates meant cheaper mortgages. But for the institutions managing trillions of dollars in pension savings and insurance reserves, low rates created a serious problem. Their traditional income source had dried up. A pension fund, the institution responsible for paying your retirement, typically holds a significant portion of its assets in government bonds. A bond is essentially a loan to a government that pays a fixed annual return. In normal conditions, that return is reliable and sufficient. But when interest rates fall to near zero, bond yields fall with them. A pension fund holding billions in government bonds suddenly finds itself earning almost nothing on that capital. Hundreds of billions in capital needed a new home. So where did it go? It went into residential real estate. And not through simple property purchases, through a mechanism called rental-backed securities. A rental-backed security works like this. An institutional investor purchases thousands of single-family homes across multiple cities. Those homes are rented out to tenants. The rent payments, collected monthly from thousands of individual households, are then bundled together into a single financial product. That product is sold to other investors as a predictable, income-generating asset. Your monthly rent payment does not simply go to a landlord. In many cases, it flows through a financial structure and ends up generating returns for a pension fund in Oslo, an insurance company in Frankfurt, or a sovereign wealth fund in Singapore. This is not speculation. This is engineered income. According to MetLife Investment Management projections, institutional investors are on track to acquire $1 trillion worth of U.S. residential housing by 2030. That figure alone would represent a fundamental shift in who owns the homes of the world's largest economy. In London, the scale of foreign and institutional ownership is already visible. Over 30% of prime central residential property in London is owned by overseas entities. In Dublin, in Amsterdam, in Berlin, similar patterns are emerging as global capital treats European residential markets as reliable yield-generating assets. But here is the mechanism that truly prevents prices from falling back to where your parents bought. The price floor. When housing prices begin to fall, as they do in every normal market cycle, ordinary buyers tend to wait. They pull back. They watch. This is rational human behavior during uncertainty. Institutional investors do the opposite. When prices dip, institutional capital sees a buying opportunity. Their models are built around long-term yield, not short-term market sentiment. A 10% price correction does not signal danger to a pension fund. It signals a discount. So they buy. This buying behavior during dips creates what economists call a price floor, a structural lower limit below which prices struggle to fall because demand from institutional capital absorbs the supply that would otherwise drive prices down further. This is why the crash, that your instincts tell you is coming keeps failing to arrive at the scale that would make homes affordable again. The correction that ordinary buyers are waiting for gets absorbed quietly by institutions executing their quarterly acquisition strategies. The yield machine does not pause for market cycles. It runs continuously. And it is not contained within any single country's borders. Because the capital funding this machine is global, it crosses borders invisibly and pools into the same cities, the same neighborhoods, and the same streets regardless of whether those streets are in Chicago, Cardiff, or Cologne. To understand the full scope of what has happened to housing, you have to zoom out and look at the global map. Here is something that should feel strange when you stop and think about it. Housing prices in London, New York, Paris, and Sydney do not just look similar. They move together. They rise together. They resist correction together. Cities separated by thousands of miles, operating under entirely different tax systems, planning laws, and local economies behave as though they are part of the same market. Because increasingly they are. To understand why, you need to understand two forces that are operating simultaneously in every major economy. The first is urbanization. The second is capital flight. Start with urbanization. Over the past 30 years, economic opportunity has concentrated into a shrinking number of cities. Not just any cities, specific ones. Economists call them superstar cities, urban centers where the highest-paying jobs, the most powerful networks, and the most advanced industries have clustered together. London, New York, Paris, Berlin, San Francisco, Toronto, Sydney. These cities have pulled talent, capital, and ambition toward them for decades, and the people moving into them all need somewhere to live. The result is a demand concentration that no reasonable supply response can match. According to the UBS Global Real Estate Bubble Index, housing in these superstar cities has now fully decoupled from local wages. The prices are no longer set by what local workers can afford. They are set by global competition for a finite number of addresses. But demand concentration is only half of the problem. The supply side has its own structural failure. In the United Kingdom, planning regulations, green belt protections, and local opposition to new development have created a construction backlog that has compounded over decades. The UK has a shortfall of approximately 4.3 million homes that should have been built over the last 30 years, and were not. That figure comes from research by the think tank Center for Cities. In the United States, single-family zoning laws in most major metropolitan areas make it legally impossible to build higher-density housing in the neighborhoods where demand is highest. You cannot solve a supply problem when the law restricts the supply response. In Germany, France, and the Netherlands, similar tensions exist between preservation of existing neighborhoods and the economic necessity of building more housing near employment centers. The result across all three regions is identical. Demand rises, supply cannot respond, prices increase. Now add the second force, capital flight. Capital flight is the movement of money from economies perceived as unstable or politically risky into economies perceived as safe and rule-governed. When a wealthy individual or institution in an emerging economy wants to protect their assets from currency devaluation, political instability, or economic uncertainty, they look for a safe haven, somewhere reliable, somewhere that will hold value. For decades, Western residential property, particularly in London, New York, Paris, and Miami, has served this function. A luxury apartment in Mayfair does not need to generate rental income to justify its purchase price. It simply needs to exist in a stable legal jurisdiction where the owner's wealth is protected. According to data from the Greater London Authority, overseas entities own a significant share of newly built residential property in central London. Many of those units sit empty. But their purchase still removed supply from the market. Their price still set a benchmark for the surrounding neighborhood. Their existence still pushed the floor of the local market upward. This is the mechanism that connects a political crisis in one part of the world to rising rents in your city. Global instability does not stay in one place. It travels, and it travels in the form of capital looking for somewhere safe to land. The synchronized behavior of housing markets across the US, UK, and Europe is not a coincidence. It is the logical outcome of a global financial system that has decided residential property in stable Western cities is one of the safest places to store wealth. Local wages did not create this dynamic. Local planning laws did not create this dynamic alone. Global capital created it, and global capital does not respect local affordability. The game changed at a level most local housing debates never reach. And that raises the most important question of this entire video. If the competition has changed this fundamentally, if you are no longer bidding against another family, but against a global financial system, what does that mean for the decisions you make about where and how you live? What does it mean for the strategy you use to build financial stability in a world where the oldest path to wealth has been repriced beyond local reach? Here is the hardest thing to accept about modern housing. You are not losing to another family with a bigger deposit. You are losing to a fund with a billion-dollar credit line. Think about what that actually means. You spent years cutting expenses, skipping holidays, watching your savings account slowly climb, and your competitor spent that same morning sending one email to a capital desk in Singapore. The level playing field is gone, and saving harder is not the answer to that problem. It never was. Here is a concept worth naming directly. Economists call it rent extraction, the process by which a larger and larger share of your lifetime earnings flows upward to asset owners, rather than circulating through the broader economy. Think of it like a sieve. Every pound or dollar you earn passes through it. What gets caught in the sieve goes to landlords, mortgage interest, and property investors. What falls through is what you actually get to spend, save, and build with. That sieve has gotten finer. In the 1970s, the average household in the UK and US spent roughly 20% of their income on housing. Today, that figure sits between 30 and 40%, according to data from the Resolution Foundation and the Harvard Joint Center for Housing Studies. That gap, that extra 10 to 20%, is not going toward your pension. It is not going toward your children's education. It is compounding inside someone else's portfolio. But here is the question that actually matters. Are you still waiting for 1995 to come back? Many people are. Quietly, they are holding out for the correction that resets everything, the crash that makes housing affordable again, the moment the market returns to normal. It will not come, not in the way you are imagining, because the system is not broken. It is functioning exactly as financialized markets are designed to function, moving capital toward yield-generating assets and concentrating ownership among those who already own. This is not pessimism. This is the starting point for a rational strategy. The numbers on first-time buyers confirm how much has already shifted. In the 1980s, the average age of a first-time homebuyer in the UK and US was around 28. Today, that number sits at 35 to 36, according to the National Association of Realtors and UK Finance's annual mortgage data. That is nearly an entire decade of wealth-building time, lost to renting. Economists and policy researchers now refer to this cohort as generation rent, a structural category, not a temporary phase. A generation for whom homeownership as the primary vehicle of wealth accumulation is arriving late, or not at all. That reality requires a different conversation about wealth building altogether, one that does not begin and end with the family home. The home can still be part of the strategy, but it can no longer be the whole strategy. Understanding how the system actually works does not trap you inside it. It gives you the only real advantage available: clarity. The system is different now, but understanding how it works is the first step toward navigating it. Let's bring everything together. Over the course of this video, three forces have reshaped the housing market permanently, not temporarily, not cyclically, permanently. Pillar 1. Institutional capital entered the residential market at scale after 2008. Firms like Blackstone, Invitation Homes, and their equivalents across the UK and Europe began treating single-family homes as a managed asset class. That decision did not reverse. It accelerated. Pillar 2. Securitization transformed individual mortgages into tradable financial products. Housing stopped being priced against local wages. It started being priced against global capital flows. When a pension fund in Tokyo and a sovereign wealth fund in Abu Dhabi are both allocating to the same housing market you are buying into, local affordability becomes almost irrelevant to price discovery. Pillar 3. Supply never caught up. Planning restrictions, construction costs, and political resistance to density kept new housing scarce. Scarcity plus global demand is not a recipe for falling prices. These three pillars did not appear overnight, but together they built something structural, something load-bearing. And here is the uncomfortable conclusion. As long as housing remains the world's preferred store of value, the asset class perceived as safest by global capital, prices will remain decoupled from what local workers actually earn. The link between a city's median wage and its median home price has not just weakened. In many markets, it has effectively broken. According to the ONS in the UK and the Federal Reserve's consumer finance data in the US, real wage growth between 2000 and 2023 averaged between 0.5 and 1.5% annually. House prices in major metropolitan areas grew at 3 to 5 times that rate over the same period. That gap is not a glitch. It is the system working as designed. So where does that leave you? Economics is the study of how systems change, not how they stay the same. And the housing system underwent a fundamental transformation in the years following 2008. We are only now, 15 years later, fully absorbing what that transformation means for ordinary households. The old model assumed housing prices were anchored to local economic conditions, to jobs, to population growth, to the cost of construction. The new model has a different anchor entirely: global capital, institutional yield targets, financial instruments that bundle your neighbor's mortgage with 10,000 others and sell it to an insurance company in Frankfurt. That is not a criticism. It is a description, and descriptions are where strategy begins. False hope is expensive, not emotionally, financially. Every year spent waiting for a crash that the structural mechanics of the market make increasingly unlikely is a year of compound growth you are not participating in, a year of equity you are not building, a year of optionality you are not creating. Clarity is the better position. Understanding that housing is now a financialized commodity, priced by global forces, concentrated by institutional capital, and resistant to the corrections that once made it cyclically accessible, allows you to make decisions based on reality rather than nostalgia. That does not mean homeownership is impossible. It means the path to it and the alternatives around it look different than they did for your parents. Different is not the same as worse, but it does require a different map. Housing isn't just shelter anymore, it's an asset. And in a globalized economy, assets don't go on sale for long. If understanding that housing is now priced by global capital, not local wages, not local demand, not the number of homes being built in your city changes how you see the property market, then you are starting to see the system clearly. That is what this channel is built for. not to tell you what to think, to show you how the system actually works, so that every financial decision you make is grounded in reality, not in an outdated model of the economy you inherited 20 years ago. If that matters to you, subscribe. Share this video with someone who is still waiting for the crash that the data says is not coming. And if you want to go deeper, our video on how money is actually created inside the banking system is the next logical step. The video is on the screen right now. The economy is not complicated. It is just poorly explained. That is what we are here to fix.